Most people believe that the rich get rich by making more money, by earning higher salaries, by closing bigger deals, by working harder than everyone else. That is what we are taught to believe. That is the story that makes intuitive sense, but the truth is far more uncomfortable than that. The real truth is that wealthy people do not focus primarily on earning. They focus on never letting go. They focus on holding. They focus on retaining. Because selling assets, the moment you convert them back into cash, is often the moment they start losing control. And what the wealthy understand about money, about assets, about how systems work, most people are never taught in school or by their parents or through conventional wisdom. By the end of this story, you will see clearly why billionaires and ultra-wealthy individuals rarely cash out, why selling can actually shrink long-term wealth even when the price rises, and how an entire financial system quietly rewards those who hold assets for decades rather than those who constantly sell and buy. There is a hidden mechanism at play in how wealth actually works, one that separates how the wealthy build wealth from how everyone else tries to build wealth. And once you see this mechanism, once you understand how it works, money and wealth will never look the same again to you. Let us start simple and build from there. Most people earn money through work. They earn a salary or a wage. They save a portion of that money, and eventually, they invest that saved money. They buy stocks. They buy property. They might start a small business. When they invest, the goal is often to buy low and sell high. They want to buy an asset at a cheap price and then wait until the price rises and then sell it. It sounds logical on the surface. It is a straightforward formula, but the wealthy operate on a completely different timeline and a completely different mindset. They do not treat assets as something to flip quickly for profit. They treat assets as something to control, something to own, something to extract continuous value from over decades. Imagine two different people. One person earns a salary, saves a little bit each month, invests in stocks or property, and when the price rises, when the investment appreciates in value, they feel a strong urge: sell now, lock in the profit, take the money and move on to something else. The other person sees the same asset rising in price and thinks something completely different. Why would I sell something that keeps producing value for me? Why would I give up the income stream it generates? This is the first fundamental divide between different mindsets about wealth. One mindset is focused on conversion, on turning assets into cash, on realizing the gains. The other mindset is focused on accumulation, on turning assets into more assets, on building a system that compounds. But here is what most people miss when they think about this: cash is static. It sits in your account. It does not grow. Assets, on the other hand, can grow. They can appreciate. They can generate income. They can create new opportunities. And growth is what compounds over decades. Compounding is how small advantages become large advantages. The wealthy understands something fundamental that the average person often misses. Ownership is not just about having value. It is about control of income streams. A rental property does not just sit there increasing in price. It generates cash flow. Tenants pay rent. That rent comes into your account every month. A business does not just exist taking up space. It produces revenue. It generates profit. A stock that pays dividends does not just rise in price over time. It pays you money to hold it. Every quarter or every year, dividends arrive in your account. When you sell these assets, when you convert them to cash, you cut off the future stream of income, and that is why the wealthy hesitate to sell. Because in their world, in their way of thinking, selling is not just a simple transaction. It is a decision to give up control of an income stream. It is a decision to step out of a position that is working for you. Here is where things get interesting and where the advantage becomes clearer. In most financial systems around the world, capital gains are taxed when realized. This means you only pay taxes when you sell the asset. So if you hold the asset and never sell, you never trigger the tax event. If you delay paying taxes, your capital continues compounding uninterrupted. The money that would have gone to taxes stays invested, stays growing, stays working for you. And this is where a subtle but powerful advantage appears. The wealthy do not just aim to make money. They aim to minimize interruptions to growth. Every interruption, every friction point, reduces long-term returns. Selling introduces multiple friction points. Taxes reduce the amount you have left. Fees from the transaction reduce it further. Re-entry risk means you might buy back at a higher price. Market timing uncertainty means you might miss gains. Holding avoids all of that friction. But here is what most people miss. This is not just about avoiding taxes through clever accounting. It is about letting time do the heavy lifting. It is about understanding that time is the most powerful force in compound growth. Now imagine something different. What if you could access the value of your assets? What if you could get cash when you needed it, without actually selling them? What if you could keep the ownership, keep the income stream, keep the growth potential, but still have liquidity? This is where leverage enters the picture. The wealthy often borrow against their assets. They do not do this to spend recklessly or to fund wasteful consumption. They do this to unlock liquidity while keeping ownership intact. So instead of selling a growing asset and losing its income stream, they use it as collateral for a loan. This strategy allows them to maintain ownership of the asset, avoid triggering capital gains taxes, access cash when they need it, and continue benefiting from appreciation and income. And this creates a powerful loop that most people never think about. Assets generate value and income. Those assets are used as collateral to access capital. That capital is reinvested into more assets. Those new assets generate more value and income. The loop continues and expands. And this loop does not require selling at all. It requires owning and holding. Most people believe that taking profits is always good, always the right move. And sometimes it is. Sometimes you do need to sell. But in long-term wealth building, selling can interrupt the compounding process. Every time you sell an asset, you reset your position. You exit the growth curve. You introduce timing risk because you now have to decide when to reinvest the money. The wealthy often avoid resetting unless it is truly necessary. Instead, they aim to stay in positions that continue to grow over decades. Because compounding rewards patience over activity. Compounding rewards time over timing. The person who tries to time the market, who tries to sell at the peak and buy at the bottom, often underperforms the person who simply buys and holds for decades. The numbers prove this over and over again. But here is what most people miss. The wealthy are not avoiding selling because they are afraid or because they are superstitious. They are avoiding it because they understand something deeper about how wealth is structured in modern economies. That structure is designed to reward patience over activity. It is designed to reward long-term holding over frequent trading. Taxes are lower on long-term gains than on short-term gains. Borrowing costs are lower when assets are stable. Income streams are more predictable when assets are held. The entire system punishes activity and rewards patience. There is also a psychological shift that happens at higher levels of wealth. For many people, assets are seen as something to turn into money, to convert into cash. For the wealthy, money is just a tool, not the end goal. They already have liquidity strategies. They already have access to credit. So their focus shifts completely. Instead of asking how much they can sell an asset for, they ask how long that asset can continue producing value. This changes every single decision they make, because now holding becomes the default rather than selling. The burden of proof shifts. Now you have to have a very good reason to sell. You have to see something that makes you believe the asset will not continue growing. You have to believe you have found something better. Otherwise, you hold. But here is where the story takes an unexpected turn. Not all wealthy individuals follow the never sell pattern forever. In some cases, they do sell, but they do not sell for the reasons that most people think. They sell when they see diminishing returns approaching. They sell when they need to rebalance their risk profile. They sell when a clearly better opportunity appears. So the goal is not literally never sell anything ever. The goal is only sell when the trade-off clearly improves your long-term position. This is a key distinction that most people miss. The wealthy do not avoid selling out of habit or stubbornness. They avoid unnecessary selling out of strategy. They avoid selling when holding is still the better choice. Now step back and look at the overall pattern. Assets generate income. Income is reinvested into more assets. Ownership is maintained over decades. Taxes are deferred through strategic holding. Leverage unlocks liquidity without forcing sales. Time compounds value exponentially. Each element reinforces the others. and together, they form a system where wealth grows without needing constant liquidation or activity. Meanwhile, the average approach often follows a different pattern: earn income through work, convert that income into assets by buying, sell those assets for cash when they appreciate, spend or redistribute that cash, then start the cycle over again. One system compounds continuously, the other cycles repeatedly. And that difference in approach compounds over decades into enormous differences in outcomes. Now bring this into today's economy and modern realities. With rising inflation, holding cash alone can reduce your purchasing power over time. Money in the bank is losing value. Central banks influence interest rates, which affects borrowing costs and asset prices. Debt, when used strategically and wisely, can amplify returns on assets that appreciate or generate income. This is why you often hear about large investors leveraging assets during periods of low interest rates. They are not just investing money, they are optimizing the relationship between time, the cost of capital, and asset growth. They are taking advantage of cheap money to buy assets that will appreciate and generate income, in an environment where money itself is influenced by central bank policy. Those who understand asset retention gain a significant edge, because they are not constantly resetting their positions, they are not constantly paying taxes, they stay aligned with long-term growth. Here is the core insight that changes everything. The wealthy do not build wealth primarily by earning more money or by investing better than everyone else. They build wealth by owning assets long enough for compounding, leverage, and time to do the work together. Selling too early interrupts that process, holding allows it to fully unfold over decades. And when assets are combined with strategic borrowing, reinvestment, and tax efficiency, wealth begins to grow in a way that feels almost magical, almost exponential. Not because of a single brilliant decision or investment, but because of a system designed to avoid unnecessary exits, unnecessary friction, unnecessary interruptions to growth. That is the real secret that the wealthy know. It is not just what they buy. It is what they refuse to sell. It is not just about picking good investments, it is about holding them long enough for time and compounding to do their magic. It is not about being active, it is about being patient. So the next time you hear about someone taking profits, about someone selling an asset after it has risen in value, ask yourself a different question than the obvious one. Instead of celebrating the profit, ask whether they are improving their overall position or stepping out of one that could have grown further. In the short term, taking profit feels good. It feels like winning. But in the long run, wealth is not just built by what you earn or what you invest wisely. Wealth is built by what you keep, by what you refuse to sell, and by how long you keep it. Time is the most powerful tool in building wealth, not intelligence, not luck, not knowing secret investment tricks, just time and patience and the decision to hold.